A family earns good money. They pay their bills on time. They avoid credit card debt. They save consistently. They buy a house. They drive reliable cars. They even contribute to retirement accounts. By almost every definition, they're doing everything right. And yet, by the time they retire, they're quietly missing more than $100,000. Not because of a stock market crash, not because they got scammed, not because they made one catastrophic decision. They lose it one ordinary day at a time. That's what makes this mistake so dangerous. You never feel it happening. No alarm goes off. No one calls to warn you. Your bank account doesn't suddenly disappear. Life simply keeps moving. And every month, a little more future wealth slips away. Here's the uncomfortable part. This isn't a story about reckless spenders. It's about responsible people. Teachers, engineers, nurses, office workers, small business owners, families that budget, families that work hard, families that genuinely believe they're making smart financial choices. Most of them are. But good decisions don't always add up to the best outcome, because money follows math, not intentions. Imagine two neighbors. Both earn exactly the same salary. Both receive the same annual raises. Both retire at the same age. One finishes retirement with several $100,000 more than the other. They didn't inherit money. They didn't start a successful company. They didn't win the lottery. From the outside, their lives looked almost identical. The difference was invisible. Tiny financial choices repeated thousands of times. That's the strange thing about wealth. It rarely changes overnight. It changes quietly. A few dollars here. A delayed decision there. One purchase that doesn't seem important. Another year spent waiting. Individually, none of these choices feels expensive. Together, they can reshape an entire financial future. Our brains aren't built to notice slow losses. If someone stole $50 from your wallet today, you'd notice immediately. If inflation quietly reduced your purchasing power over the next 12 months, you'd probably blame rising prices. If your investments earned slightly less because your money sat in the wrong place for 10 years, you'd never see the wealth that could have existed. That's the real danger. The biggest financial losses often never appear on a bank statement. Economists have a name for this. Opportunity cost. It sounds technical, but the idea is surprisingly simple. Every dollar can only do one job. Spend it on one thing, and it can't do something else. Leave it sitting in cash, and it isn't compounding somewhere else. Use it to buy something that loses value, and it can't be invested into something that grows. Every financial decision quietly closes hundreds of other possibilities. Most of the time, we don't notice, because humans see what happened. We almost never see what could have happened. That's why opportunity cost feels invisible, and invisible problems are easy to ignore. Let's look at an example. Imagine someone receives a $10,000 bonus. They're careful with money, so they decide to leave it in a savings account. It feels safe, responsible, even smart. After all, the money is still there. Nothing was lost. Or was it? Suppose that same money could have been invested for 30 years, not chasing risky investments, just broadly diversified assets with long-term historical growth. The difference isn't measured in hundreds of dollars. It's measured in tens of thousands. The decision didn't destroy money. It prevented future money from existing. That's a very different kind of loss, and it's much harder to feel, because you can't miss something you never had. That's why middle-class families often underestimate the cost of waiting. Waiting for interest rates to improve. Waiting for the perfect market. Waiting until life feels less busy. Waiting until the kids grow up. Waiting until next year. Financially, waiting isn't neutral. Waiting is a decision. Time doesn't pause while you're thinking. Compounding keeps moving, whether your money is participating or sitting on the sidelines. Here's the next section of the script. This is where the first major mistake appears. Confusing safety with certainty. Keeping money safe feels responsible, and sometimes it is. Emergency savings matter. Cash has a job, but many families quietly give cash a job it was never designed to do. They expect it to build wealth. That's like expecting a parked car to win a race. Cash protects. Investments grow. Those are two different missions. The problem begins when one replaces the other. Imagine leaving most of your long-term savings in cash because investing feels risky. On the surface, nothing bad happens. Your balance stays stable. You sleep well. The numbers don't swing wildly, but something else is happening. Inflation is quietly shrinking the purchasing power of every dollar. The money isn't disappearing. Its buying power is. It's like filling a bucket with water while someone drills tiny holes in the bottom. The bucket still looks full until you actually try to use the water years later. History shows something interesting. Markets rise, markets fall, sometimes dramatically. But over long periods, productive businesses have continued creating value. New companies replace old ones. Technology improves. Productivity increases. Entire industries appear that didn't exist a generation earlier. Owning a small piece of that progress has historically been one of the most powerful wealth-building tools available. Not because markets never fall, because they recover, adapt, and continue moving forward over time. Many people understand this, yet they still wait. Why? Because the human brain doesn't measure risk very well. We fear losing money we already have, far more than missing money we could have earned. Psychologists call this loss aversion. Imagine someone offers you two choices. The first guarantees you keep exactly what you already own. The second has short-term uncertainty, but a much higher long-term reward. Most people instinctively choose certainty, even when the math favors patience. That's perfectly human. It's also expensive. Now let's look at the second mistake, lifestyle inflation. It sounds harmless, almost positive. After all, shouldn't life improve as income increases? Of course it should. The problem isn't earning more. The problem is spending every raise before it has a chance to change your future. A promotion arrives. The paycheck gets bigger. Almost immediately, so do the expenses. A nicer apartment becomes a larger house. A reliable car becomes a luxury SUV. Vacations become more expensive. Monthly subscriptions quietly multiply. None of these purchases feels outrageous. Each one seems justified. You've worked hard. You deserve something better. And sometimes you do. But lifestyle inflation has an interesting habit. It raises your cost of living faster than your feeling of happiness. Last year's luxury becomes this year's normal. Then next year's expectation. The finish line keeps moving. Imagine two co-workers receiving the exact same raise every year. One quietly increases investments before increasing spending. The other upgrades their lifestyle first. 5 years later, their daily lives look surprisingly similar. 25 years later, their financial lives look completely different. One owns freedom. The other owns bigger monthly bills. That's the hidden cost. Not what you spend today. What today's spending continues costing you every year afterward. A single upgrade rarely stays a one-time expense. A larger house often means higher taxes, higher insurance, more maintenance, more furniture, more utilities. A nicer car often means higher insurance, higher registration costs, more expensive repairs. Small upgrades rarely travel alone. They bring friends. And those friends send invoices every month. This is why wealth and income aren't the same thing. Income is what comes in. Wealth is what stays. Someone earning twice your salary can still end up with less money if their expenses grow just as quickly. That's why some households earning modest incomes quietly become wealthy, while others earning six figures constantly feel financially stretched. The difference isn't always income. Very often, it's the gap between earning and spending. If you'd like, I can continue with the next section covering the third hidden mistake: buying depreciating assets with appreciating debt, followed by the simple math that reveals where the $100,000 actually disappears. The third mistake is harder to notice because it usually arrives wearing the costume of success: a bigger paycheck, a better job, a promotion, a bonus. Suddenly, borrowing becomes easier. Banks are happy to lend. Dealerships approve larger loans. Monthly payments still fit the budget. Everything feels affordable. But affordable and inexpensive are not the same thing. Imagine buying a brand new car. The moment you drive away, its value begins moving in one direction: down. Your loan, however, doesn't care. The payments continue. Interest continues. Insurance continues. Maintenance eventually arrives. The car may bring years of convenience, but financially, it's fighting an uphill battle. This doesn't mean buying a car is a mistake. Most people genuinely need one. The mistake is confusing a necessary purchase with an investment. An investment puts money to work. A purchase puts money to use. Those aren't the same thing. Now imagine repeating this pattern every few years: a newer car, a slightly larger loan, a slightly higher payment. Individually, each decision seems manageable. Collectively, they quietly absorb hundreds of dollars every month, money that could have been compounding instead. This is where the math becomes uncomfortable. Let's say someone spends an extra $400 every month, upgrading their lifestyle. Not recklessly, just choosing nicer options whenever income increases. $400 doesn't sound life-changing. Many people spend that without thinking twice. But over 30 years, that monthly decision becomes enormous. Not because of the spending itself, because of everything that money never had the chance to become. This is the part most people never calculate. They compare today's purchase with today's bank balance. They almost never compare today's purchase with 30 years of compounded growth. That's the invisible bill, and it's usually the most expensive one. Now consider another habit that feels completely reasonable: trying to perfectly time the market. Someone says they'll invest after prices come down. Then the market rises, so they wait. Eventually, it falls. But now the news is frightening. The economy looks uncertain, so they wait again. Months become years. Years become a decade. Meanwhile, the market continues doing what it has always done, moving unpredictably in the short term, while gradually rewarding patience over the long term. Ironically, people often feel safest investing after markets have already gone up, exactly when optimism is highest, and they feel most afraid after markets have already fallen, exactly when prices are lower. Human psychology quietly encourages buying high and avoiding opportunities when they're cheaper. The market doesn't reward confidence, it rewards discipline. That's an important difference. The families who quietly build significant wealth rarely predict the perfect moment. They simply keep showing up. Month after month, year after year. They continue investing during exciting markets. They continue investing during boring markets. They continue investing during frightening markets. Consistency doesn't make headlines, but it has built more wealth than almost any prediction ever has. This brings us to another invisible expense: fees. Not dramatic fees, tiny ones. A little percentage here, a slightly higher management cost there. Maybe an unnecessary financial product that sounded impressive. 1% doesn't sound dangerous. In a single year, It usually isn't. Over 30 or 40 years. That small percentage quietly compounds against you, just like investment returns compound for you. Compounding works both ways. It rewards efficiency, and it punishes unnecessary friction. Most people spend hours searching for a cheaper television or a better deal on a smartphone. Very few spend the same amount of time reducing the lifelong costs attached to their investments. Yet one decision might save $100. The other might preserve tens of thousands. The difference isn't intelligence, it's visibility. People optimize what they can easily see. They ignore what unfolds too slowly to notice. Now let's put all of these small decisions into one picture. Imagine two families. Same city, same age, same household income, same number of children. Neither family is unusually lucky. Neither is unusually talented. On paper, they're almost identical. Family A does what most people would consider perfectly reasonable. They keep a large amount of cash sitting in savings for years. They upgrade their house every time their income rises. They replace their cars every few years. They wait for the right time to invest. They occasionally panic when markets become volatile. None of these decisions feels extreme. In fact, each one can be justified on its own. Family B doesn't make dramatically different choices. They simply make slightly different ones. They keep an emergency fund. But they invest long-term money instead of letting it sit idle. They buy reliable cars and keep them longer. When they receive raises, they increase investments before increasing spending. They invest consistently, even when the headlines look scary. They avoid unnecessary fees whenever possible. From the outside, their lifestyles look almost the same. Their neighbors probably can't tell the difference. Their friends probably can't tell the difference. Even they may not notice much difference during the first 5 years. That's what makes this story so deceptive. Compounding is incredibly patient. It doesn't impress anyone at the beginning. The first year looks ordinary. The 5th year looks modest. Even the 10th year may not seem extraordinary. Then something interesting happens. The returns begin earning returns. Those returns begin earning even more returns. The snowball finally becomes large enough to create its own momentum. This is the moment most people mistake for luck. Someone suddenly appears wealthy. Friends assume they must have received an inheritance, or picked the perfect investment, or had some secret advantage. In reality, the biggest advantage was usually time and consistency. The math was doing most of the work. This is why the $100,000 mistake is actually a misleading title. For many families, the real number is much larger. Sometimes it's $200,000, sometimes $500,000, sometimes more than $1 million. Not because they made terrible decisions, because they underestimated how powerful small decisions become after decades. Here's the irony. The middle class is often told to focus on cutting small expenses. Skip the expensive coffee. Cancel one subscription. Bring lunch from home. Those habits can help, but they're rarely where life-changing wealth is won or lost. The biggest financial decisions happen far less often. Choosing where long-term savings live. Deciding how much lifestyle should expand after a raise. Buying assets that grow instead of liabilities that shrink. Starting early instead of waiting for certainty. Those decisions echo for decades. The daily coffee rarely does. This doesn't mean you should never enjoy your money. Quite the opposite. Money is supposed to improve your life. The goal isn't to become the richest person in the cemetery. The goal is to spend intentionally. Not automatically. Because every dollar has options. Some buy comfort today. Some buy freedom tomorrow. The difficult part is that you usually can't have both with the same dollar. So before making your next financial decision, ask a different question. Not, can I afford this? Most people stop there. Instead, ask, what is this dollar giving up if I spend it here? That single question changes everything. Because wealth isn't built by avoiding every purchase. It's built by understanding the true price of each one. And the true price is almost never the number printed on the receipt. It's the future that money could have built instead. That's the part no receipt will ever show you. And perhaps that's why so many intelligent, hard-working families lose more than $100,000 without ever realizing they paid the bill.